All right, how do you deal with recording the issuance of bonds? Study Objective 5 deals with issuing bonds at face value. That means issuing bonds at the amount stated on the bonds. Okay, so that means if you have, like down here in this example, they issue $100,000 bonds. So that's $100,000 in face value that they're issuing out to investors, and they're issuing them at face, which means the investors are going to pay them that $100,000 for those bonds that have a face value of $100,000. So this is how you record a bond issuance at face value. The company gets the cash, they record the liability that they're going to have to pay back. Over time, the company's going to have to record interest expense and interest payable, and then record those interest payments to all those investors. So here's the interest calculation, face value of all the bonds, annual interest rate. It's a full year being calculated here. So here's the entry to record the bond interest expense. This is no different than a note payable scenario. Paying off that interest, no different here either. You pay off the interest payable and credit cash. Notice there's no debit to bond payable here because the bond itself is not being paid off. That is, some future maturity date, and that will be paid off at that time. And then this is what I was getting into in the last video about discounts or premiums on bonds. So read about this. This is a really good illustration that shows you what a bond or how a bond will be issued at, either a premium or a discount. And it all depends on whether the bond rate of interest is more, equal, or less than the market rate of interest. So just read through this and pay close attention to how the entry goes to recording bonds at a discount. So in this case right here, these bonds are issued at 98. That means 98% of face value, or $98,000, since they're $100,000 face value. So they get in the cash of 98. What gets recorded then is this contra liability account, discount on bonds payable. So these two things will be recorded in the same section of the balance sheet. It'll say bonds payable 100 less discount of 2. So the carrying value of these bonds will be 98,000. And then the part that kind of gets outside of the scope of our class is that this discount will be kind of amortized down over the life of the bonds, so that by the time the bond reaches maturity, the bond payable amount will be the full $100,000, and then they'll pay off that full 100 at the maturity date. See right here, here's the balance sheet presentation. It doesn't really go through a premium situation, but if bonds were issued at premium, say they're issued at 105, then they'd be getting $105,000 for these bonds. The bond payable is still a credit of 100, but there'd be another credit of premium on bonds payable of $5,000 over here. So the debits would equal the credits. And in the balance sheet section, you'd have bonds payable of 100 plus premium of 5, so you'd get to 105 would be the carrying value. That premium would be over time amortized down, so that by the time the bonds matured, it would be 100,000, same as in a discount scenario. But that's beyond what you need to know. You just need to get what it means to issue bonds at premiums and at discounts, and how to record those issuances. And we're going to skip the rest of the chapter, so no need to look at further study objectives in this chapter.